Hello, Guezzin members. Today we're breaking down one of the most important topics for new market participants, market conditions, specifically bullish, bearish, consolidating, and volatile markets. Understanding these terms will help you read charts more confidently and make more informed predictions inside Guezzin. Please note there may be some terms in this video you are not familiar with, such as higher highs and higher lows, lower highs and lower lows, earnings, support and resistance, and volume, to name a few. We'll be sure to cover these in future videos. For now, let's dive in. Before we look at each type, let's define what a market condition actually is. A market condition describes the general direction or behavior of an asset's price over a period of time. Think of it like the mood of the market, whether buyers are in control, sellers are in control, or nobody really knows what's happening. Now let's look at the four most common market conditions. A bullish market means the price is generally moving up over time. Here's how you can recognize a bullish market. The chart forms higher highs and higher lows. These are areas where the direction changes briefly and then reverse again to continue up. Be sure to look at the closing price and opening price, as wicks can sometimes overextend themselves before reversing. Buyers are consistently stepping in. Confidence is usually higher. News sentiment often leans positive. Bullish markets aren't always a straight line upward. Prices can pull back or dip, but the overall trend remains up. Examples of what causes bullish conditions are strong company earnings, positive economic data, optimistic market sentiment, or increased demand for the asset. Why this matters for Guezzin? When predicting closing prices, knowing the overall trend helps you understand if the market is drifting upward, which can influence whether prices might close higher than the previous day. A bearish market is the opposite. Prices are generally moving down. How to identify a bearish market? The chart forms lower highs and lower lows. Sellers are more aggressive. Sentiment becomes negative or cautious. News tends to focus on economic slowdowns or risks. Bearish conditions can be triggered by weak earnings, negative economic reports, rising interest rates, or global uncertainty. And why this matters to you? Understanding whether an asset is trending downward can help you decide whether prices may continue to drift lower toward the close. A consolidating market, sometimes called a sideways market, happens when prices are not moving up or down in a meaningful way. Instead, the price moves within a range, bouncing between a support level and a resistance level. Characteristics include no clear trend up or down. Price moves sideways. Uncertainty or balance between buyers and sellers. Often happens before a big move. And what causes consolidation? Traders waiting for major news. Market taking a pause after a strong trend. Or low volume or indecision. Why this matters for Guezzin? In a sideways market, predicting the closing price is less about trend direction and more about recognizing the range where price has been settling throughout the day. A volatile market is one where prices move quickly and unpredictably. This is where you'll see big swings, up 1 minute, down the next. Signs of volatility include large price candles, rapid changes in direction, wider trading ranges, high volume, and the cause of volatility could be economic announcements, earnings releases, unexpected news, or global events. Why this matters to you? Volatility creates greater uncertainty. Predicting closing prices becomes more challenging, so it's important to recognize when the market is acting unusually fast or unpredictable. To quickly determine the market condition, ask yourself these questions. Is price generally trending up, down, or sideways? Are highs and lows getting higher or lower? Is the price moving calmly or jumping around? Using these clues, you can classify the current environment in just a few seconds. Always remember the time frame you're using to identify market conditions, because in a single asset, you may find all 4 market conditions depending on the time frame you're using. For example, the charts in this video are all Bitcoin. The bullish example was with a monthly chart. The bearish example was using a daily chart. Consolidating in the 1-hour chart, and volatile using a 1-minute chart. This is called top-down analysis and will be discussed in detail in a future video. And that's it. You now understand the 4 major market conditions: bullish, bearish, consolidating, and volatile. Recognizing these conditions can help you approach your predictions with more confidence inside Guezzin. Thanks for watching, and we'll see you in the next lesson.